Welcome back to the Foundry by Forge College. So, in our previous lesson, we dove deep into ASIC architecture, really looking under the hood at the sheer physical power of these modern mining machines. But today, well, we're pivoting a bit. We're moving from silicon chips straight to spreadsheets. Because, as it turns out, creating magical internet money actually requires some pretty mundane math. If you want to actually survive in this game, you can't just go out and buy the biggest, loudest machine you can find. You need to know exactly how it pays for itself. So, in this explainer, we're calculating cost and return on investment for hardware.
All right, here's our blueprint for today. We'll start with the hardware ROI challenge, then compare capex versus opex, calculate our monthly profit, find that crucial break-even point, and finally we'll stress test our setup.
Okay, let's dive right into section 1, the hardware ROI challenge, moving beyond just raw hash rate. You see, the absolute most common rookie mistake in Bitcoin mining is what I like to call hash rate blindness. It's just so incredibly tempting to look at a hardware catalog, find the machine with the absolute highest terahashes per second, and immediately click buy. But honestly, treating raw computing power as your only metric is a fast track to completely burning through your capital.
Because ultimately, every single miner has to answer this $1 million question. How long until this machine actually pays for itself? We've got to take all those abstract hardware metrics and translate them into cold, hard dollars and calendar months. If you don't know your timeline to profitability, well, you aren't really running a business, are you? You're kind of just gambling with some very expensive space heaters.
Which brings us to section 2, capex versus opex and understanding TCO. To answer that timeline question accurately, we really need to arm ourselves with some fundamental financial vocabulary so we can properly understand the main categories of our costs. When we put those cost categories together, we arrive at this foundational concept, total cost of ownership, or TCO. Simply put, this is the combined total of your upfront capital expenditure and your ongoing operational expenditure over the entire lifespan of the hardware. Keep this super clear and jargon-free in your mind, okay? TCO is literally the ultimate metric for your financial survival. It represents the total, real-world reality of what your rig actually costs to run, from the very minute you unbox it to the sad day you finally unplug it. So here's how that split looks. First, you have capex, or capital expenditure. This is your upfront cost, that heavy hit to your wallet when you actually purchase the ASIC itself. Then you have opex, or operational expenditure. This covers the ongoing stuff, your electricity, mining pool fees, maintenance, all of that. Think of it like buying a vehicle. Capex is the painful check you write to buy a brand new car off the lot. But opex, that's the constant drip of paying for gas and oil changes over the years. You can't just budget for the car itself, you've got to budget for the whole road trip. Moving right along to section 3, calculating monthly profit, applying constraints. All right, enough theory. Let's go on a little hypothetical shopping trip and actually apply these concepts mechanically. Let's say we're evaluating these 3 distinct ASIC candidates for our operation. Option A is our beast, right? The high hash rig. It costs a steep $9,000 and pulls a massive 3250 watts, but it pumps out 110 terahashes per second. Now, on the completely opposite end, we've got option C, our low-power machine. Much cheaper upfront at $3,500, sipping only 1,200 watts, but you only get 45 terahashes. And then option B sits pretty comfortably right in the middle. So looking at these, which one is actually the smartest financial buy? To figure that out, we need to build a spreadsheet using this step-by-step scaffolding. First, we gather our baseline assumptions. Second, we calculate our monthly electricity cost. Third, we project our gross monthly revenue. And finally, we subtract those costs from the revenue to find our true monthly profit. And just as a quick aside, mastering this exact kind of structured step-by-step analysis is a huge focus of the learning tracks we offer over at Forge College. It's truly how the professionals separate the signal from the noise. Let's zoom in on step 1 and see how this builds our analytical foundation. Here are our baseline assumptions. We're estimating electricity at 8 cents per kilowatt hour, 98% uptime to account for routine maintenance and things like that, a 2% pool fee, and a hypothetical revenue of 45 cents per terahash per day. Now, we absolutely must document these assumptions explicitly. Why? Well, because the Bitcoin network changes constantly. If we just hard-code these numbers directly into our math, our entire model breaks the second power prices fluctuate. By keeping them as adjustable baseline parameters, our spreadsheet stays incredibly powerful and flexible. Which leads us to section 4, the break-even point, finding your ROI. With our monthly profit calculated, we can finally navigate to the ultimate destination of our mathematical journey.
finding that exact moment on the calendar when your machine has mined enough value to completely pay back its own purchase price. And here is the golden formula to find your break-even months. You simply take your upfront purchase cost and divide it by your monthly profit. It's super simple, but man, it is ruthless. If your monthly profit is a negative number, meaning your electricity literally costs more than the Bitcoin you're mining, well, congratulations. Your break-even time is essentially infinity. You are quite literally paying out of pocket just for the privilege of making a lot of noise and generating a ton of heat. Now, what's really interesting about this slide is the final profitability ranking. Look at option A, our expensive, high-hash beast. It generates the highest absolute monthly profit, which sounds amazing on paper. But because of its massive $9,000 price tag and its huge power consumption, it actually has the slowest payback period. Meanwhile, option C, that little low-power underdog with the lowest monthly profit, well, it actually pays for itself the fastest. This just goes to show that blindly buying the most powerful machine isn't always the fastest path to recouping your capital. Finally, we arrive at Section 5, stress testing your setup to handle volatility. Because before you rush out and buy a massive fleet of those low-power machines, we really need a reality check. As beautiful and perfect as spreadsheet numbers look on a screen, the real world of Bitcoin mining is chaotic, unpredictable, and downright messy. So we perform what's called a sensitivity check, and we usually start with a plus or minus 10% variance. Ask yourself, what happens to your break-even time if your electricity rate suddenly jumps by 10%? Or what if your ASIC runs 10% less efficiently because, say, your facility gets a bit too hot in the middle of summer? When you run these scenarios, you'll often find that just a tiny 10% tweak in operational costs can completely flip our hardware rankings upside down, literally turning yesterday's best buy into tomorrow's worst liability. So the absolutely crucial takeaway here is this: small differences in efficiency compound over months and materially alter your break-even periods. Efficiency, meaning exactly how much hash rate you get for every single watt of power, is the most critical lever within a miner's control. It dictates your opex, which dictates your profit, which ultimately dictates your financial survival over the long haul. Which leaves us with a slightly terrifying but very important final question. What happens when the real-world performance of your machine just doesn't match that shiny marketing brochure? Well, to find that out, you'll have to join us in our next explainer, where we'll dive straight into measuring actual physical hardware efficiency right on the test bench. Until then, if you want to master more of these fundamental concepts, really refine your operational spreadsheets, and dive way deeper into Web3, definitely head over to forge.college. Check out our detailed learning tracks and just keep building. Thanks so much for joining me on this explainer, and I'll catch you next time.